Heather, it's great to have you on the show. I've known you for a long time now. I want to first congratulate you on your new role as the chief economist at the Navy Federal Credit Union. Something that I think most people don't know about you is that you actually started out in financial economics. You have a master's degree from Oxford. You were a Rhodes Scholar. You were also, of course, an award-winning economics reporter at the Washington Post and CNN, which is where you and I met. And so I wanted to start with, why you love economics. What about the subject excites you? What do you like most about studying it, about covering it?
It's such a great question. Yeah, it's been a wild journey with a lot of moves, and some of which I didn't anticipate. If you had asked 18-year-old Heather, what the trajectory was going to be. So, I always tell people there's no wrong turns in your 20s, but maybe I should say there's no wrong turns in your 40s either, at least mostly speaking.
Exactly.
But look, economics for me, I was really fortunate. I went to a public high school in Mechanicsburg, Pennsylvania, and they actually had an economics course, a really basic economics course in high school. And even then, I went back recently and reread the yearbooks where people write in your yearbook, and so many people were like, "You're such an economics nerd." So I guess 16-year-old me kind of knew from that. And what really drew me to it is economics has become very mathematical over time, and a lot of college courses start with the equations. But to me, it's really a philosophy at heart. And I was fortunate, as you mentioned, to study economics at the graduate level at Oxford University, which looks at it much more in their famous PPE, philosophy and politics and economics program, much more as a way of seeing the world, a way of trying to understand, why do people make the decisions they do? Why do companies make the decisions that they do, or governments make the decisions that they do? When I was in college, 25 years ago now, game theory was really taking off, and these, questions about when rational decision making breaks and why does that happen, and plus this huge explosion of women entering the workforce and trying to better understand the role of women in the economy. So all of that stuff really attracted me, economics, and then I'll just throw in that my father was an accountant, so I guess I kind of wanted to follow in his footsteps, but not exactly. He still chides me for not having an accounting degree.
That's funny. I mean, I think our parents always have hopes and dreams that I feel like that's like a whole separate conversation. So
yes.
let me just
stop
go there
but
for now.
I empathize with everyone who had to have those conversations with their parents, and now that I am a parent, I have this with my own child about what you're studying and what your interests are.
Yeah. Well, I bring up your background as a way to kind of ground our conversation because you're not sort of a traditional economist if you're thinking about, like most people, if they had like a path through academia, and the fact that you've covered the economy, the U.S. economy for major media brands. You really understand what the public craves in terms of understanding the economy, and you have really specialized in understanding, especially the middle class. You're one of the foremost reporters on the economy during the pandemic, and you are sort of continuing to sort of play that role, especially obviously when you still talk to media. But I do wonder how you have maybe changed the way that you've looked at the economy since you've taken on this new role, and what you still hope to do in this capacity.
Yeah, a big part of the reason that drew me to Navy Federal Credit Union, partly I've been a member here. My dad is an Army vet and they have a great reputation, but it's really a voice and a look into the middle class. We have 14 million members at the moment, almost 15 million. And most of our members, it's not just military or veteran families, but it's also their families. And a lot of the family members are very much the middle class of the middle class. Most of our network of members is what we call the smile, the bottom smile of the United States. So from Washington, D.C., down the coast into Florida, into Louisiana, into Texas, and, across to Arizona, and then up towards San Diego. And this is, very much the fastest growing part of the American middle class, where a lot of middle class people have moved to find more affordable housing, more affordable childcare. And so I just really felt that this organization's mission was very much aligned with, as you said, my background, my interests, and my mission about wanting to be a voice for the middle class. And one of the really neat things now that I get to do that I didn't as a journalist, I spent a lot of time traveling the United States to better understand the on-the-ground realities that were going on in the pandemic and otherwise. But I think for me now, I have this amazing visibility into, almost 15 million member accounts. And so when we're having these discussions about is employment going up or down, is consumption starting to falter? Are people still in the middle class still doing discretionary spending? I don't just call up 3 or 4 people and get a few quotes. I can see actual data in real time about the economic trends, and that's been really exciting. I'll just highlight one, and if you want to pick up on more on it, but something that's really stood out to me this summer since I joined Navy Federal, I spent a lot of time, with our call center folks who are on the front lines every day, and obviously looking at our data. And one of the trends that's stood out to me in the job market is what I call job downgrading. And some of that is people who maybe had a federal government job, paid a pretty good salary, 100,000 or so, and now they've had to leave the federal government and take, a position maybe in retail or more of an hourly type role. But what we're seeing more of that stood out to me when I started to look at our data and our anecdotes is people who used to get a lot more overtime hours at work. And overtime hours are precious. Those are paid at time and a half. Now, nobody wants to work 80-hour work weeks. There's too much overtime. But for a lot of middle class Americans and, working class Americans, it's those overtime hours that really add several $100s, if not, 1,000 or more extra dollars of income a month to your budget. And so people have been calling in telling us, look, I'm still employed, but my hours are down. Or I used to get, even if I were driving for Uber or Lyft, maybe, they used to be a lot more generous with the bonuses, that if you did a certain number of rides a week, you'd get an extra $200 bonus, and that they're seeing less and less of that. That obviously impacts their ability to make their budget work, to make all their payments. But I think you can see it in the national data. So I went back to the national data like, wow, where is this? Why aren't people talking about this? There has been a decline in the average work week. But I think that's some of the strain that you feel, even though the unemployment rate remains low, 4.2%, it's probably could rise somewhat in the coming months. But it's that tension of people's day-to-day reality is paring back, even if they still have a job.
Because a lot of the government data that comes out on a monthly basis is so backward looking, and the time periods are also a little bit tricky with some middle of the month, data gathering, survey data gathering and extrapolation. For you to get a real, full, complete picture of the U.S. economy, what are maybe the 3 or 4 groups of data sets that you like to look at to give you that complete picture when, as you just said, with the overall unemployment rate doesn't tell obviously all the nuanced stories. So when you want all of the nuance, what are those metrics that you turn to?
That's a great question. And I think everyone's trying to reassess what those metrics are in this new environment of reassessing government data and what's going to be available going forward. And so, at Navy Federal Credit Union, we've been trying to build out our own, we call it health check on the economy. For instance, we're paying a lot more attention to our direct deposit data. So, we have millions of people who are direct depositing every week or every other week from their paycheck, and that's our best reality check on the employment data. So far, it's held up pretty well, but as I was talking about earlier, we're monitoring for if those amounts are growing or if they're getting smaller. I think could be key as we move forward. Another one that we're watching really closely, I think everyone's trying to get better handle on the consumption data. And obviously there's the PCE type indicators that come out every month. I remember during the pandemic, we were all looking at the open table restaurant reservations. Even the Federal Reserve would talk about things like that. Yep. But it's, look, we're starting to do this at Navy Federal. I know Bank of America Institute and JP Morgan Chase Institute have done similar things with their card data. We're really trying to drill into different income levels of credit and versus debit card spending. We're seeing more of a caution and pullback on discretionary on the credit card side for middle
Mm,
class. Whereas basically it breaks down to folks who are spending, who are in income class 170,000 or above. And you can debate what the line of like, oh, is this person rich or not, depending upon if they live in New York City or San Francisco or Washington, D.C. or Texas. But, basically there's this, the higher end consumer is fine. They're still growing year over year, their spending, including discretionary spending. But it's a really different story for the middle class and certainly lower income consumers. They're spending basically what they were spending on their credit card in 2019. Once you adjust for inflation, there's really not a lot of growth there. So we're watching that very closely. I think it's one of the key parts of the inflation story, as I keep stressing to people. The middle class is tapped out.
yeah.
That doesn't mean that they're all, can't make their payments now, but there's no extra money. It's very different than 2022, when the last time we had an inflation spike and, people still had pandemic savings, they still had stimulus payment savings, and people were still spending like crazy. It was the revenge spending era. And I think brands were really shocked that they kept raising prices and consumers kept coming. They were
Mm.
waiting for people to really, even complain. And it's just very different this fall, this winter, heading into 2026. It's a very different picture with the middle class. There is pushback to rising prices, and brands know this.
So before we talk a little bit more about the middle class, I want to also continue on your look back because, as we talked about with your background, you've been studying the economy, you've been studying economics for decades now, and I know that a lot of economists, one of the reasons I enjoy talking to economists is that they always see the bigger picture. It's the whole point of this platform, but that they also see things in cycles. And so, some economists that I talk to look at what's happening and they, I would say like shrugging it off maybe a too casual description of their tone in responding to these questions, but they have a more subdued sort of attitude towards some of the things that they're seeing because I think their perspective is we're going to see things come around again and, cycles change. I do wonder though, if from what you're seeing, there has been a marked difference, an inflection point from which we'll never get back to previous cycles. Is there anything to suggest that there should be more permanent worries around trends that we used to see that you don't think we'll see again?
Yeah, that's a great question. I mean, whew, I guess I would say it this way. I see it more as a political crisis that I keep calling it the K-shaped economy is
Yes.
back. We're in this world where the top 20% is living one type of life where their spending continues to grow and the bottom 80%. We're not talking about the bottom third or 40% that has long struggled, but we're talking about really the bottom 80% is in a strained environment. Sure, many of those people can still make their payments right now, but they're very, very strained. There's not a lot of extra. They're frustrated. I was at one of our branches recently, and one of the tellers said to me, "Does it just feel like everyone's in limbo?" Which I thought was a really interesting way of putting it. I was like, tell me a little bit more. And he's like, so many people, they're coming in here and it's just, they maybe have a little bit of extra money, but they're like hoarding it in cash. They're so worried. And I think we've just seen this year after year, really since the Great Recession, but certainly in the last 10 years, this nervousness, this frustration with the economy, this belief it's not working. Obviously, people are voting to try to send a signal that they want dramatic change, they want to shake things up, and I just don't see how it feels like we're back into that and cycle, and that it will continue in 2026 and maybe even in 2028 in the next presidential election. I don't see anything that really says to me the middle class breaks out again. And and we had that rare period during the pandemic, bizarrely, where people great reassessment of work, great resignation, they were able to get better jobs, higher paying jobs, and quit and feel like they had some autonomy. They had all that extra savings. They were living a better life, really, a better financial life in many ways. And that's over. And I just struggle to see the optimism around what really kickstarts a better period for the bottom 80%.
And and this is from your Washington Post, your latest. This we're taping in August of 2025, where you cite Moody's data saying that top 10% of earners drive about half of the spending, and that's up from 36%. That's just from 3 decades ago. So I would expect then that this is kind of what you're talking about, that the top earners will continue to drive a greater share of spending overall, and that trend is one that you do not see changing for the foreseeable, let's just even call it 2 to 5 year period to 10 years. Is that an accurate reflection of how you're feeling and what you're seeing?
Yes, I think so. Now, the 10-year mark gets a little bit more interesting. I mean, it just
Okay.
feels like at some point there will be a revolt. We've already kind of seen it a little bit with the election and rise of Donald Trump as one way that voters are trying to signal their dissatisfaction and their belief that they want a very different direction for the nation and specifically for the economics of the nation. And in the next 10 years, I was talking to somebody recently. I said, look, 2030 feels like it'll be a big inflection point. You've got you're be only a handful of years away from Social Security, probably having to be cut, the payments reduced because we no longer have the fiscal capacity to do that. And at the same time, our fiscal situation is worsening, and people will have lived through another cycle or two of this pretty frustrating economic situation. And so it feels like a lot of things will kind of come to roost. AI will be more prevalent throughout the economy. And while I think it'll bring a lot of productivity advantages and other stuff, such things, is that something that really trickles to middle class gains? I don't know. That's where I think. So yeah, I know it sort of feels like 2030 is this moment, give or take a year, that could be very pivotal.
So if we are going to, though, from what I'm hearing you say, going to see this trend continue of higher earners driving more of the spending in the US, what happens to the products that we consume? Are companies, do you expect, going to operate very differently? How are lives day to day going to change in the US as a result of this very bifurcated, or not even this K-shape that you're talking about?
Well, we can already see some early signs of it, and I think they'll be exacerbated. So you have a lot of companies trying to cater more and more to the high end. I keep using the example this summer of the credit card companies. There was all that kerfuffle around the Chase Sapphire credit card raising their annual fee from, I believe, $500 to $750. Then you saw Amex, one of their cards, did the same thing, and Citigroup soon followed with a card of their own that was even more exclusive, so trying to raise the bar even more to this perception of uber luxury. You see the same thing with cruise ships. They're creating these uber luxury experiences on private islands and whatnot, and smaller ships that are more catering to a wealthier clientele. At the same time, on the flip side, the Walmarts of the world are doing well, right? So if you're perceived as a value brand, as where people go to hunt for bargains, you're doing well. Who's struggling, broadly speaking? It's all the brands that cater to the middle class. Target is probably one of, and Starbucks are some of the better examples. Middle of the road, classic company, the middle class shopping at Target, carrying their Coach or Kate Spade bag, in a purse, and going out to eat at an Olive Garden or other chain restaurant. And a lot of those type of middle of the road brands are the ones that are really, really struggling as the economy shifts in 2025 and 2026. And I think will continue to struggle long term in this bifurcated economy where they're clearly not catering to the top, but they're perceived as a place to downgrade if you're a middle class consumer.
Do you sense that especially now with middle class that you're talking to more day to day, that like the quality of life will change for people who, in a different way? I mean, the quality of life has always been different depending on your income level, but do you see just a much more precarious situation in the past. Back to this maybe inflection point that we are near or at or just past, where we will never be able to support this 80% in the same way because companies are chasing this growth, on the other spectrum.
I could certainly paint you a pretty grim picture. I try to be an optimistic person by nature, but I do think over and over again, a couple of things come out in surveys, data, or in focus groups, and that's in the political context or the economic context, or my own kind of traveling of the country, and that is a longing for more stability. And where's the stability going to come from? AI is dramatically shifting our economy again, among other forces like an aging society and a nation that has a fiscal imbalance. So all of this is going to force pretty big changes. And at the same time, what comes up over and over again is housing and affordability, childcare and affordability, and healthcare being unaffordable. These are like three really basic items. And I would say what's shifted in the last few years since the pandemic, and this trend could easily continue, is it used to just be the New York Cities and San Franciscos of the world were super expensive. And, like my hometown in Harrisburg, Pennsylvania was seen as, hey, you can go there and get a really nice house for, $150,000, $200,000, or certainly under $300,000. And so there were plenty of places to go, smaller cities in America that still offered a pretty great middle class life. And what's really changed is almost all of these places, Phoenix, Arizona, Tampa, Florida, these types of smaller cities that used to be middle class bastions, they've seen home prices shoot up 30 to 50% too, right? And so even though it's still cheaper, way cheaper than New York or Washington, D.C., for the middle class, there's just not many refuges left where you can go now. Maybe Cleveland, but parts of the Midwest. But it's just harder to find that place where can you get a nice home in a good school district for $300,000, $400,000 that still feels attainable. Somebody corrected me, like it's not affordable housing, it's attainable housing. Everything has to be attainable.
LA semantics are important.
Yeah, but you know what I'm saying. I think
totally. That's
where I feel for the younger generation, for Gen Z and those coming after, that getting those basics is much harder. It doesn't just feel harder. Like statistically, it is harder. I don't see that changing. Some states are doing a better job than others at building more housing and trying to at least curb the price growth in home building, but it doesn't feel like we're really going to fix our housing supply problem. And same thing, with healthcare. We're removing government supports for healthcare. Unless there's a major reversal in that in the next few years, we're going to have more uninsured. I think the real crisis is going to be underinsurance, both in healthcare and housing and autos. It's just gotten to the point, people can't pay for the premium that they should have, the coverage they really do need. And so that just raises the risk that something goes wrong, a disaster strikes, either you personally or your community, and you can't rebuild. You can't get back on track, or it's very, very hard, way harder to do that.
This other topic I want to get with you is the idea that social media has democratized lots of information sharing, but it's also introduced a lot of misinformation. And from what you can see, what are some of the most egregious types of misinformation about personal finances, about the economy, about like the real estate market, for example, that, you wish you could take a full-time job just to combat all of that you see?
There's so much. I mean, you're right. On the one hand, look, in America, most schools are not teaching personal finance. And so on the one hand, I'm glad that there is this proliferation of TikTok and Instagram videos and that young people are craving this knowledge. But you're right. Sometimes I'm sure you have the same reaction that as someone involved in finance and involved in economics for many years that, I would say some of the top ones that really stand out to me, the climate of fear, sort of fear mongering, either telling people to take their money out of the market or telling people to invest heavily in, say, crypto. And look, I'm not against crypto. I think it should be part of a portfolio. But again, it's the one thing to take 5% of your investable wealth versus, 50 or 60 or 80% of your investable wealth into Bitcoin or whatnot. So there's that kind of stuff that comes to mind. I can tell you from the Navy Federal Credit Union side that we also see a lot of people getting bad advice to, open extra credit cards, to do it at midnight. If you log on at this certain time, you could, pull some fast cash scheme kind of thing. And it's like, look, if it sounds too good to be true, it is. Another one we've seen in recent years is people learning from social media that they don't have to repay their debts, their credit card or their auto loan or their car loan, and they try to write in and cite some non-existent provision of the Constitution where they claim that they are a sovereign entity as a person, like I'm like a sovereign nation, so so we don't have to pay back this. It's almost laughable, but unfortunately they watch some video and they are convinced that this will get them out of repaying their debts. And unfortunately, what they usually end up with is, defaulting or becoming delinquent on a loan and then having this really big black mark that follows them around for a long time of a lower credit score or these sorts of things. So yeah, I wish there's some great advice out there, but there's definitely some wacky advice too.
Do you ever go into the comments and just say, hey, Economist here? Are you one of those people who like debunk in the comments? Because to your point, I think people know that there's bad advice out there. And so people run to the comments. And so there's a little bit of like a social check and balance situation happening. But yeah, do you ever do that?
I should be better about it. I will say I really love Reddit. I've been a longtime fan of Reddit, and I do feel that with Reddit, I don't know if it's because the users are older or what, but first of all, you tend to get a range of responses to any financial questions that are posed there, or really any question at all posed there. And usually, I feel like when you read through, 10 to 50 responses, enough of the good stuff surfaces. Enough people are saying the right thing that it drowns out some of the bad information. And I don't feel by and large that TikTok and Instagram are there yet. And you're right, maybe it's just the culture needs to change of how people interact in the comments. TikTok does have that great feature where you can take a snippet of what somebody said and then make your own video off it. So I try to do a little bit more of that to correct misinformation or to just say, wait a minute, not that.
That is a very nice public service that you are offering. And I agree with you. I do like Reddit a lot myself. I was using it earlier this year when I was looking into like home buying. And I think for the consumer, hopefully, maybe you agree with this, I see one kind of group of people who are becoming savvier to be able to read between the lines and, make up their own minds in some ways, like taking into account the range of comments, reviews, upvoted, threads to do that. I think one of the other, challenges of social media.
Let me just jump in there because I feel like I've been a little pessimistic so far, but you're right. One of the stats I always keep on my desk is that the United States, I know we were talking about the K-shaped economy earlier, but the United States has over 20 million millionaires. Not everybody's Jeff Bezos. A lot of these people are very middle class people who did what you said or what's recommended and saved, bought a modest house that they could afford, and they were able to accumulate in their retirement plans over the years enough that they crossed that $1 million mark. And so you're right. In that sense, the right information, it's a good reminder that there are people doing the right things. And we even have a lot of people who call into Navy Federal Credit Union. A big part of what we do is education. And I'm happy to say a lot of people call in. They say, what podcast should we be following? What content should we look at? We have our own Making Sense podcast. But, we actually have people who serve as a frontline financial advisor to help people proactively before they get in delinquency. Maybe they're trying to do the right thing and they want to grow their wealth over time. So we have this whole program that we say, not yet on the housing, like home buying, they're on track, can't do it, not today. but soon, and trying to really shift that mentality to the proactive mindset.
When you have people who are coming, to you for advice, and as you're talking to folks in the middle class, I'm curious, as they're getting maybe their hours downgraded, if they're turning to gig work, something that I'm always asking for. I think I've asked and emailed the BLS a couple of times about this, but when are we going to get accurate data around the gig economy? What is the best way to measure the size of the gig economy, or people who are, moonlighting, they're doing something on the side?
I agree with you, Hope. The United States needs better data on the gig economy, and let's call it even the influencer economy. I will say, to the Bureau of Labor Statistics credit, they did start trying to monitor some of this back as early as 1995. But it's still really based on these surveys. They call it the Current Population Survey, CPS, where they're going out in the field asking people kind of, what do you do and how many hours, and do you do it for a company? And I think a lot of people, particularly young people, just don't think about work in the same way in those terms. And when they're being asked, is this a full-time or a part-time, and how many hours a week do you do it, it can vary a lot week to week. And so at the moment, they have this survey that they do every couple of years that they call the Contingent Worker Survey. What a weird title, Contingent Worker Survey. And that's their best take on the gig economy. And the last time they did it was 2023, and they said that only 7 million people were part of this contingent work, which can be everything, which is basically like 1099. It can be everything from somebody driving DoorDash or to, an influencer or whatnot. So it's a lot of people who, again, are not fully a full-time hire for somewhere, but they are clearly doing a significant either part-time or full-time of their working life in these types of roles. And, it was definitely more for young people. The 16 to 24 crowd, under 25s, had 4 times as likely to be in this kind of job. I think that rings true. But a lot of people, when that 7 million number came out, just shook their head and said, this can't be right. At the moment, they don't even have a category called influencer. So they just put people, they try to ask them multiple questions and figure out, are they like a media content creator? Are they a PR person? Are they an advertising person? I mean, how would you classify yourself, Hope, if you were being asked these questions? I feel like you would struggle to, media content creator. Does that feel right?
Yeah, I mean, I think the way that my, sole proprietorship is set up is I think I describe myself as a media company. So, and, I get to this question because, as you know, the labor force participation rate has been kind of falling, which is concerning for many economists. And I just wonder if that's, maybe potentially because people are, not opting into the traditional form of work, and if it's just shifting. So I would love your take on that. And then just related to this, there's also been a lot of discussion around how companies want to grow in the future. And with AI investments being so high, you're seeing a lot of companies looking more for freelance workers, more for people who, aren't as expensive because of of benefits and things like that. And so those two together, I'm generally just very, very cautiously, I wouldn't say optimistic, but I think a lot of people are optimistic that this could be like the new way of working, and it could lead to a lot of freedoms. And I know you have a very different perspective on it. So on those two separate things, the labor force participation rate, how you see that trending, and also this idea that if the labor force is more contingent workers or freelancers, how we accurately capture that value to the economy.
Ooh, 2 big questions. Look, on
Yes.
labor force participation, I do think the the two bigger drivers to the statistics are the retiring baby boomers, obviously a force bringing it down, and frankly, immigration. It was a huge surge after the pandemic, and now we're obviously in a very different environment where migration and immigration, may even decline this year and next. And so there's a number of factors that are adding more downward pressure to labor force participation. But you could argue, okay, well, let's just look at prime age, and I would still say that the immigration movements are way bigger at the moment than anything from gig economy or influencer economy factors. But you're right, in the coming years, some of that could change. And I think to me, one of the bigger factors is the women's labor force participation. You see a huge surge in women are very good, and you're a good example, and many of these new roles that are being created, and it's a chance, including this trad wife, whatever you think of the trad wife type of option. I think it's really a reflection that we don't have enough opportunities in the economy for people, parents, women who want to work from home for whatever reason, caring for elderly relatives or younger children or wanting something very different in life. And so, they sort of feel like this gig economy work is their way forward, particularly their influencer work. And is that all being fully captured in the current data? I'm like you. I'm pretty skeptical that we're fully capturing it. I do think there's a lot of reasons to be concerned about what's going to happen at the Bureau of Labor Statistics in the coming years. But funding is obviously being down. We're going to have some new leadership. But one of the more encouraging signs is there's a lot more openness to using revising surveys and to looking at private sector data. And so, I think there will eventually be ways to look at, the data, maybe even from TikTok or Instagram or other monetization platforms, to be able to get a better handle on how many people are doing this work and, how significant their earnings are. It's one thing to be doing a small side hustle that's bringing in $1,000 a year. It's another thing for somebody to have, this is their income. This is their $50,000 a year or more income.
The one thing I do like about private sector data, like from a MasterCard or an Amex, for example, is that it's more real time, and and you can really get the actual figures that, like even Bank of America, for example. I know you brought that company up earlier, where you can see the deposits, or you can see where the inflows and outflows are, like you're doing at Navy Federal Credit Union as well. And so the idea, though, that you brought up earlier around certainty is also, I think, very applicable here when it comes to the overall trusting of the institutions that are presenting this information to us, because at least we all had that as the grounding, set of points to refer back on, and we could have a common conversation. This to me also feels like another inflection point, because if that certainty and the trust has been taken out from under us, that leads to a lot of issues, right? Even for you as an economist now, to try to project and try to advise and try to plan. So what is your sort of best advice for anyone and everyone going through this in their mind? Like, who do I turn to trust? What data points do I look to trust?
Yeah, a couple of thoughts. Yes, at the moment, I often say the hardest job in the world is to predict right now the 10-year Treasury yield for 2026. Where is it going to be by the middle of the year? Where is it going to be by the end of the year? And a lot of that is just what we were talking about. There's so much uncertainty and so much risk, particularly around the actions of the United States government. Whether it's on data, whether it's on how they're trying to influence the Federal Reserve, whether it's on trade, there's just so many moving parts, whether it's the fiscal outlook and what will happen there. And it seems very, very odd that the 10-year Treasury yield has been so complacent so far in 2025. They saw a little bit of an uptick in April, May, in the early days of the tariffs. But so I think that will continue to be a big driving force in the economy, and at some point is going to revalue, and there's going to be a lot more risk, particularly in the out years that people see, investors see in the United States.
What do you mean by complacent? Just really quickly.
It's not moving up. Like look in the last few weeks even when all of these seemingly huge shifts of firing a BLS commissioner and reinstating or trying to put in someone, who most people think does not have the usual background and credentials and certainly is very politicized. And now with what's going on in attempts to remake the Federal Reserve and to pressure rates to go lower through that process. At the end of the day, it's a lot of these very institutions and places that have been seen as very stable. I mean, you and I were just poking a little bit that we wish that there were better measures of the gig economy or the influencer economy. I mean, there's certainly criticisms of these institutions, but they have been just bedrocks, reliable, the models for the rest of the world. And now they're going to get a lot more political, and there's questions of trust. And so how do you react to that? I can tell you how we're thinking about it, how I'm thinking about it, and that is you need dashboards of indicators. I mean, we're back to the days where you can't just look at PCE, CPI, unemployment rate, and GDP. That those days are over. And, you could argue they've been over for a while, but, for us, it's obviously utilizing our internal data. It's obviously looking at so many more private sector indicators that are being put out. I really love what Anthropic's doing with their new AI economy index, and things will get better over time. Obviously we have groups like ADP that are going out there, and in the various Indeed type job indexes that are out there, Glassdoor and what they put out. So you have to kind of piece it together. And it's one thing if one data point or looks a little bit funky, okay, maybe you discard that as an outlier. But when people tell me how are we going to know if the government is tampering with the data, I'm like, it's actually pretty easy, because not only could there be whistleblowers from inside those institutions, but the private sector has a lot of data now, a lot of data on people's employment through their direct deposits, on even just tracking the cell phone patterns of, are people out and about spending, or are they all huddled at home, and if they're huddled at home, are they still spending on their phones? Like, we just know so much right now about where people are and what they're doing with their money and what they're doing with their employment situation. And so if the government's saying, oh, the unemployment rate is 2%, I think a lot of people are gonna say no. Like, no, this does not match the reality that we see with the data sets that we have access to.
And you think there will be enough of these brave voices to put out contrary data sets? Because that's like been another concern, right? The silencing that a lot of people have experienced, the pressure. So just really quickly on that. And then I want to go back to the 10-year, because, the complacency, I would love for also you to extrapolate kind of what that suggests in the minds of the holders of the treasuries.
Yeah, I would say it this way. Even if companies, private sector organizations are not willingly putting out their data, they are operating on that data and trading on, on some of their knowledge of what's incorrect. And so that will begin to show up. And one of my most watched TikTok videos was shortly after President Trump was reelected, and I said, look, the number one thing you need to watch in the Trump economy is the bond market. And in many ways, it's been true. When the bond market has reacted severely to something the president has done or attempted to do, the White House has generally backed off. Because the bond market plays directly into borrowing costs, both for individuals and for the U.S. government. And that's a real strain. And President Trump understands that as a former real estate person. You can argue how successful or not he was, but look, real estate people understand the movements of the bond market and how it impacts borrowing costs. And so that's kind of where I think you would see something. If Navy Federal Credit Union and Goldman Sachs and JP Morgan, all these people, if we have our own data, or the tech companies that really is different from what we're seeing coming out of the federal government, we're going to make very different business decisions than what you would do if you thought the unemployment rate was 2 or 3%, if we think it's actually 6.
And so just to put the finer point on what you think that complacency suggests, and
Yeah, right
why and
now.
yeah, and why you think for the 2026 10-year, like that, why that is the one to watch as well.
Well, I think right now it's a very short term mindset where the market investors seem really thrilled about the progress of Nvidia and the other big Magnificent Seven tech stocks, and they're really excited, many people, about the September Fed rate cut and probably a second one, maybe even a third one by the end of the year. I think that's too aggressive, but there's sort of this trajectory for supporting the stock market. There's a pretty good thesis for the rest of the year, but I think the outlook really starts to shift when you get to 2026. You see a lot more divergence of views about where the economy could be, about where the middle class could be, and certainly layering on top of that about where the politicization of various core financial institutions could be and regulators could be. And so that's where things really start to shift. And I don't think it would take much once once you start to see, say, the 10-year or the 30-year treasury bond start to people kind of run away a little bit from those and the
Mm,
yields start to rise, then I think
mm,
all these risks come back to the forefront of, oh, wait a minute, yeah, it's not just that we were worried about the politicization of these institutions, we're also worried about that fiscal picture that doesn't look that great, and so you can just see how it could turn really quickly. Doesn't happen in 2026. I think there's a good chance we see some dramatic movement at some point in 2026. Is that the final inflection point? No, we've got many more years to come. But once it starts to move, it's very hard. It's very hard to put the genie back in the bottle.
and when you say many more years to come, are you talking about like 3 to 3 years? Is that
Well,
is
it's
that
really 10 years on the fiscal picture. I mean, the number I always keep in my mind, it moves a little bit, but 2033 is when the Social Security is likely to not have sufficient funds to pay everyone what they're currently getting paid. And that means an automatic haircut, that changes if it's around 12%, 15%, whatever. But the point is, that's going to be a dramatic moment, a dramatic reckoning that's coming. And I think the closer we get to that 2033 marker, the more the fiscal picture becomes real for everyone, and the more that tough choices have to be made or not made, and then the risk premium really goes up. Is the U.S. government going to repay its debts? Right now, we're very far from that, but you can see like how this is going to keep popping up, even beyond the actions of the White House.
and that's why a lot of people have drawn the sort of narrative around the only sort of thing that Trump listens to is like the bond market, right? Like that's he actually has been responding to that. Just really quickly, the independence of the Fed is crucial. I mean, that is like an understatement. What is the worst case scenario for the economy, for businesses, for consumers, if President Trump has more of a say in putting people on the board that might be more amenable to what he wants to do? And what's the best case scenario?
Yeah, I wrote a piece for the Washington Post where I said I keep hearing the song lyrics, you don't know what you've got till it's gone. And that sort of feels pretty apt to think about central bank independence. Many of, we've taken it for granted since 1913 and the creation of the Federal Reserve. Now seem to be at an inflection point, if not today, then in 2026. And I think a lot of people, in short, what does it mean if the Fed becomes politicized? Higher costs. It means that there's higher borrowing costs because probably things like the 10-year and 30-year Treasury yield go higher. Investors want more of a premium to loan the government money. And the other thing of higher costs is inflation. I mean, when the Fed is artificially keeping interest rates low to please the White House, that means they're not paying attention if inflation starts to rise. They're not going to be quick to raise interest rates again to try to stem that inflation. In the worst case scenario, you get another Argentina where you have a lost decade, or some would argue lost decades of lower economic growth and even potentially falling incomes if inflation spirals out of control for many years and the broader world loses faith in the US dollar and in US assets. More likely what would play out, I mean, that's the worst case scenario. I think more likely what plays out is they move to a point, say, Fed Governor Chris Waller, elevate him to be Fed chair. He's seen as more, moving a little bit towards what the White House wants, but not, not a demagogue, not a totally super political person, who's someone who believes in the Fed, who believes in the core principles of the Fed. So I think that's where I certainly hope they'll end up. I think that's why the market hasn't had a more dramatic reaction so far to the attempt by President Trump to attempt to fire Fed Governor Lisa Cook, is because they think that's the direction that Chris Waller will be elevated. But the big thing that a lot of people are not writing enough and focusing enough about is, regardless of what happens with Lisa Cook, the reality is, as Fed Chair Powell steps down next year, you're in a scenario where the president is able to appoint a majority of the Fed governors of the 7 governors in DC. And what a lot of people forget is, yes, there's these 12 regional Fed banks across the country that act as sort of a check and balance to the D7 DC crowd members. But those 12 regional Fed presidents are technically rubber stamped every 5 years by the governors in DC. And their next rubber stamp is supposed to be early 2026. And so that's where, it's never really happened before, ever. But that's where, if suddenly the president really wanted to put his appointees on the Fed board and tell them to not rubber stamp these 12 regional Fed governors, or at least not some of them, that would be kind of crazy town. That's just blowing up the Fed and the Fed as we know it.
And and my mind is spinning on those worst case scenarios, because we're only a couple months away from 2026. What should business leaders do? Can consumers do anything in preparation for a scenario like that?
Yeah, I think it's really hard to assess the wide range of outcomes in 2026. Look, I'll say what I do personally, because that's the advice I'm truly taking. And I have been holding, we all have the ideal is to have an emergency fund. Some people debate 3 months, 6 months, 12 months. I've certainly been holding more cash than I normally would. I move it into T-bills or into CDs to try to earn a little bit of return, but I've definitely had financial advisors tell me, the traditional advice is you should be putting more of that money to work in the markets. And I get that. I get what they're saying, but, there is something to be said in times of uncertainty and times of crisis to be able to have a little bit more of a reserve fund and a rainy day fund than you normally would. And I think a lot of companies are thinking about it like that. And you've seen, outside of AI investing, getting all the headlines, you've really seen a pullback on business investment at the moment in times that we're in. And again, one of the big question marks for 2026 is, do businesses start to open their pocketbooks again and start to make those longer term investments, or do they still see just too much uncertainty to do that? So I think you see that limbo that's going on for both consumers and for businesses right now.
Well, that limbo is not a place that business leaders like to be in, because their whole job day to day is to predict the future and try to build things for that future where they think they're going. I know this is not your day job to do, but to be responsible economically, to care for the health of the overall economy, what would that type of responsible action look like if you are advising and counseling business leaders at this moment?
It's tricky. I'll tell you the way that I think about it. My biggest concern, as someone who thinks a lot about the middle class and the labor market, is the other way to manage uncertainty. Maybe they're not investing, but the other way to protect your profit margins is to cut costs by cutting headcount. And we've seen a little bit of that. Certainly in the tech sector has done a lot of that in the last 2 to 3 years. And does that spill over into other sectors? So far it's been a frozen job market. No hiring, not much firing. But does that start to move? And what really freaked me out when I saw the July jobs report that really changed people's minds here in August 2025 about the economy was how many different sectors are actually doing layoffs. And it's not just the federal government or K through 12 education. It's things like manufacturing and retail. And white collar, professional and business services, and to see all of those different sectors start to, be negative for the past 3 months, that begins to raise some red flags for me. It's early days, it's early signs, but that starts to look more like a tipping point of, are we entering the, CEO mentality of let's cut costs by laying people off or really scaling back hours, which is almost like a layoff.
Well, it's funny. That's not the answer that I expected because I feel like that's what companies like to do. They also get a little boost in their stock price, but the overall economic effect is that that worker is a consumer of another business, or maybe it's even a consumer of your own company. You're really taking out your own customer base. So it's almost like, to me, like an intense stalemate. And tell me if I'm like oversimplifying kind of the challenge, but that's sort of the way I see how interconnected all of our like lives are. As workers, as, consumers, as people who are, like feeding into the economy and making growth happen, whether it's on the productivity side or on the consumption side.
Well, all I can say is Navy Federal Credit Union, we were founded in the 1930s, and we have actually never done a layoff. So we buy into everything that you just said, Hope, that we believe in our people, we move people around, people who were part of helping out with the mortgage division and the crazy spike of home buying in 2021, 2022, they have been moved to other parts in some cases of the organization. We didn't just lay them off like a lot of other financial companies did to their mortgage divisions. So yeah, we hardly believe in what you're saying, but you're right. It's pretty unusual. We don't have shareholders. We're a credit union. And that's one of the differences in the models of different types of companies, and right or wrong. In the US, a lot of the CEOs. One of the charts that's really shocked me, that my friend Andrew Van Dam, the Department of Data columnist at the Washington Post, highly recommend his work, but he did this wonderful graph that looked at how employment in the United States, we always think of ourselves as a nation of small business. And maybe we get back there in the influencer economy as there are more and more people like you, Hope. But right now, that's not where we are. For the first time ever, we have more people working for large companies than small. And you can debate, is the tipping point 100 people or 500 people? But more and more Americans work for really large companies. Because that's where the jobs are, that's where the opportunities at the moment there are, and that's where the growth is. But those companies, as you say, if you're working for a 24,000 person company or 100,000 person company, I don't mean to be mean, but you're kind of a nobody. You're right. You are more expendable than you are if you're at the 50-person company where everybody's known each other and known the cousins and in-laws for years. And it's just, you don't want to show up in the grocery store and have somebody say, "Why'd you fire my son?" It's a different conversation.
This is a stupid question, but is there a better model? Is one of them, is one sort of source of employment, supply of employment, better than the other?
It's a good question. People would argue that a bigger company offers more opportunities. I certainly was talking to someone this week at our company who, moved from Texas to Virginia for a great opportunity of advancement. So, I can spin this a lot of different ways. But I do think I think part of the frustration in the American middle class, going back to that, is just feeling like you're expendable, feeling like you have no power anymore. That comes up over and over again in focus groups, even Republican focus groups. Leaders there say it's amazing how many times people will rail against large companies, and in a way that you would have heard in a Republican focus group, even 15, certainly not 20 or 30 years ago. And a lot of it is whether, you feel like the big tech is stealing all my data, or you feel like, large banking organizations are ripping you off by giving you, almost no interest or whatever. Or you feel like you are expendable. Boom, the pandemic shows up, you get fired. There's no thought of, oh, this is a crisis and we need to all band together. Boom, you're cut. Or times get a little rough, boom, you're cut. So you're right. I'm grossly oversimplifying, but those are the kind of sentiments that do play into where Americans feel things are. And you're right. If I'm trying to be a little hopeful at the end here, there is maybe something to this influencer economy and this notion that middle class voices, regular people voices, can rise up, can be viral, in this world where you feel like you have so little power against larger organizations.
I love that. I want to end our conversation with kind of where we started, which is this K shape, and how long you think that shape will persist, and if there's a better shape of the economy that we should strive for and to work toward, and how do we get there?
It's such a good question. I wish I had a great answer. Um, I think there's a couple of ways you can get to some, I don't know what the right shape is, something that looks a lot more, a lot, a lot flatter, frankly, than a K, whatever letter that would be. You don't want to end up with an E, maybe, but or there's tops and bottoms and then weird middle. But what I'm trying to say is, look, I've seen some people make the case that having more employee ownership in companies, something more like a German model potentially, or could be a way forward. Some people advocate for that. Some people obviously advocate for unions to come back. I don't see that happening, but that could be one path. I think another path is we just taking a really hard look at what kind of basics the government pays for. Many other countries, our neighbors to the north and Canada, we can debate how good their healthcare system is, but they do have a subsidized healthcare system. They do have subsidized childcare. We've made some different decisions in the United States, but I think over time the pressure will grow to find more ways to support middle class families than what we have now.
What are the risks, or what are, if any, upsides to having a K-shaped economy for longer?
Well, I think we're seeing some of them play out. People are frustrated, they're angry, they're revolting. They're revolting at the ballot box and voting for dramatic change, and they know it's very hard to answer your question, what do you want it to look like? But people know it's not working the way they want, or the way that they feel it worked, maybe in the 50s or 60s. So I think, around the world, everyone's trying to figure out what those right path forward is. And ultimately, as a nation, we're going to have to tax the top more. It's a reality. We will get there eventually. I know politically it can be very hard. But there's just really no way around a scenario where we can have this K-shaped economy existing forever, and so many people not fall behind, but certainly aren't getting to the place that they would like to be. Let's put it that way.
Let's end with a fun question. You were experimenting with TikTok, quite a bit for a little while. What worked for you? Because for a lot of people, it's still, even though you and I have done television, it's like still a very unnatural sort of communication style. And I look at it sort of as a language. So I would love to know, as somebody who's been much more successful at the short form stuff, what was that moment for you that when it clicked maybe, or, was it something that you saw that also maybe influenced the way that you started to create content in that way?
I know. I feel like I've become a TikTok champion, which is definitely not something I foresaw a year ago. So life can change. Your views can change a lot. I'll give you a short anecdote. And I was fortunate to attend the White House Correspondents Association dinner for media folks in DC recently. And more people came up to me to talk to me about the TikTok videos I was making than about the Washington Post columns I was writing, or TV hits or radio hits I was doing. And that really floored me. I mean, I was like, wow, I'm in a room full of media people, and they're like, wow, what you're doing on TikTok's pretty cool. I was like, wow, not what I expected. I am not super funny. I am a good tap dancer. I tried to do a couple of tap dance videos. Those did not do as well as I was hoping. Tap the economy was my original idea. But I tell you what really works. I call it a one-hit wonder. And it's just when you have that emotion in your voice. Honestly, some of my best ones have been, I was sitting in a car one day and just pulled up my phone. I felt very self-conscious about my nose. The makeup wasn't great. But you're just telling it how it is. You're telling the reality of, this is what I see right now. This is what I'm concerned about. You're keeping it short, concise. And usually I'll try to make a couple of different takes, and I'm terrible at editing. So I just end up with the first one. 99% of the time, it's the first take of just letting it all out. You had something here on your chest that you needed to get out. And I think that also is why so many people on TikTok are successful from just walking around, like walking around holding the phone through the woods or something, because it's that similar, like, the person I tried to call and tell this didn't pick up. So let me tell you, camera. And
Okay,
the world
okay.
can feel, they can feel that emotion. They can feel that passion. And I think there's just, as we were talking about in this video, there's a huge hunger to better understand economics and finance. And even at Navy Federal Credit Union, I do a monthly economic brief, 30-minute lunch and learn. And we've had 1,000 people show up from our company, and a lot of them are frontline workers from call centers and bank tellers, and they want to know. They want to know more.
I love that. I think it's something that I'm learning from you too, because I think a lot of people feel when you look at a video that it like is super produced or like you need a lot of writing and editing. But like what I'm really hearing is that it can come through. Like, you might not think that it does, but people are actually picking up on it through these videos. So I love that. I love chatting with you. You're one of my favorite economists, one of my favorite people. I hope you enjoyed your time here and that you'll be able to come back. And, I know we have a lot more to discuss, especially when it comes to half of the labor force, women. There's just so much more there. But I want to thank you. Is there anything else that you wanted to say just for today or for this particular episode?
Thanks for doing Macro Talk and for being a great interviewer, Hope. You're one of the best.
Thank you. I really appreciate that.